Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Coming to you today with a brief market update, kind of let you know what's going on out there. S&P 500 right at about 49.75. That is up about 4.9% for the year, down about 1% off the highs that we recorded in very early February, but still sort of flirting right around that 5,000 mark that seems to be psychologically important, if nothing else. And that's really driven by two factors. We got earnings season, kind of the tail end of fourth quarter earnings season going on, as well as the continued dialogue around inflation and interest rates coming out of the Fed. First and foremost, earnings season, how about 80% of the companies report, 396 to be exact. And numbers coming in a little bit ahead of expectations, but I just want to be clear what that means because it's normal to be ahead of expectations. So earnings per share coming in at about plus 5% year over year versus analyst estimates of more like 2% earnings growth. Revenues coming in at up about 3.5% versus about 3% revenue growth for analyst estimates. And of note, about 80% of the companies that have reported have come in with results that exceeded the analyst expectations. So, if you just looked at that on face, you'd be like, wow, that's a great year. But then if you take a step back from the data, you'd start to realize that normally, in any quarter, about 2/3 of companies wind up beating analyst expectations. It's a little expected for them to beat expectations. And the fourth quarter is normally even a little better than that. Historically, on average, in the fourth quarter, about 76% of companies that report wind up beating the analyst numbers. I don't know if that's because the analysts sandbag a little bit. I don't know if that's because the companies give the analysts sandbagged guidance. Regardless, I would just say that this earnings season is shaping up to be kind of exactly down the center of the fairway of what a rational person would expect to happen, which explains why the market's not moving too terribly much around the news. The other narrative that's out there is around the CPI. Last week, the Bureau of Labor Statistics reported a core inflation, that's once again inflation excluding food and energy, that was up 0.4% month on month. Now that's a little hotter than we wanted. Certainly higher than expectations of sort of 0.2 to 0.3, depending on who you were reading, and probably a lot higher than the 0.2 to 0.1 that we'd like to see to be comfortably within the range. And that's really down to a couple of factors. First is January was pretty hot. Unemployment numbers looked very, very good. Wage numbers looked very, very good during the month of January. And consumer confidence numbers looked really, really good. And when you put all of that together and combine some, 10-year Treasury interest rates that came down quite a bit, all of that stimulative, we certainly saw that in terms of spending patterns in the month of January. That 0.4% is not enough to get the Fed to really change their narrative on the market. They are still looking for interest rates having peaked, and the next move is probably down. But I would just note that the Fed has a wait-and-see approach with respect to all of this. And the number that we saw in January was certainly, I won't say a step backwards, but not a move in the right direction as far as inflation is concerned. It ain't over till it's over. We've been saying that for a while now, and the inflation print that we saw last week certainly adds a little bit of caution to the notion that there's an interest rate cut coming, certainly anytime in the near term, and maybe interest rates have to remain at 5.25 for a while before we get that inflation genie under control. So we shall see what we shall see. With that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.